informal discussions with a large number of our stakeholders. And we enjoy this room, and we also enjoy going down and having our Pani Puri and Patties and all that downstairs, which is our standard fare for our SEBI at 35. But let me come to today, and I know that many of you are quite puzzled as to why we are having a press meet completely out of syllabus, right? I assure you there's nothing controversial. Essentially what we thought was, and I'll actually move to my first slide to depict that, is that all of you are very familiar with the mandate that SEBI has of development of the market, regulation of the market, and investor protection. However, when we go from a quarter-on-quarter meet after each board meeting, the focus is very much on the new regulations which have been approved by the board and which tend to be a cross-section of regulations across various types of entities, across various domains that the markets really cover. So what we thought was that it might be a good idea for us in a year to have 3 thematic discussions on each of these areas to talk about how we see things both in terms of looking back over the last year or so, as well as looking forward on each of these areas. So this is what we hope to do going forward. So you may receive an invite after a few months on the second thematic discussion as well. But this is the first one. And the focus this time round is development of the market and capital formation. Many of you may recollect that one of the first public addresses that I had made, I had talked about how for SEBI we are very, very conscious of the fact that capital formation is the core reason why we exist. Everything else is peripheral, incidental, very important, but peripheral to the key task of capital formation in the economy. And I think that today we are all in a very, very fortunate place as a country and as market participants and as market observers, that India is in this wonderful position where we have a very, very strong and robust economy which continues to grow despite a lot of headwinds, which are global headwinds. And some of the factors that I choose very often to share with many of our global investors and other people who come to meet with us. And I start always with an apology to say that I'm not an economist, and therefore I tend to look at things quite simplistically. But the 2 sets of metrics that I always look at, one is tax collections and the other is power consumption. If I want to get a sense of where is our economy today and where is it headed, then I look at these 2 numbers. Why tax collections? Because as we all know, nobody pays taxes unless they have to. And also, which many people who come from overseas are not familiar with, that we have a concept of advance tax, right? So on the one hand, we look at GST numbers, and when we see the month-on-month numbers looking so robust, that gives us a lot of comfort that the economy is really doing exceedingly well. At the same time, when we look at advance tax numbers, in a way, that is a forward-looking statement by every corporate in the country about where they expect their profit numbers to be at the end of the year. And when we see that also, direct tax collections also improving quarter on quarter, advanced tax payments, again it gives us tremendous comfort to share with the global investors that the growth of the economy is real. And you know, there's so much going for the way in which the Indian economy is functioning. The reason I also like to look at power consumption is because, to me, that is an important indicator of the real economy. So there is a lot of a good part of our economy is in relation to the financial sector. But if you look at the real economy, that's where manufacturing happens, that's where agriculture happens, that's where things are created and bought and sold. And so the real economy, for me, a very good metric is the power consumption. So I like to track that. Of course, it tends to be cyclical based on the weather, but if you really normalize for that, again, it gives me a lot of comfort and a lot of capability and strength of numbers to be able to discuss with all our foreign investors who come to visit with us. So, in a nutshell, we are in this really good place today as a country, and therefore our role in terms of capital formation acquires even more importance, because the appetite is there. As a destination for investment, everything is in the right place. We need to ensure that that facilitation in terms of what the market mechanisms are continue to be there. So as I said, today's meeting, the focus is on capital formation and what is it that we feel, on a look-back, rear-view mirror basis, where have we reached? Because this is an important mandate of SEBI. And also going forward, what is it that some of the things that we are wanting to do by way of facilitating development and ease of doing business. So the first area I would like to take us through is really what is happening internally in SEBI. And this is something that we have not often talked about. You would have noticed in some of the data that has been circulated that perhaps for the first time we are sharing what is it that is a result or an output of the processes that SEBI is following. And I think what we articulated again 5 quarters ago was that in the process of capital formation, delays cost the ecosystem. And everybody knows and understands that time is money, money is time. And I had joked that, as an investment banker, I had been acutely aware that any delay on the part of the regulator and the markets meanwhile move, and then an opportunity to raise capital just vanishes overnight. This is a very serious issue, and therefore we decided to first of all start measuring very, very carefully our turnaround times. And here I would like to emphasize that in many places the time is measured from the time of last communication with the applicant, or as we as regulators say, receipt of all documents and all information. Okay. That has been the traditional way of looking at things. In SEBI, we are now looking at it completely differently. So the data that you see, the start date is from the date of first application. So we do not give ourselves the leeway of saying that, the last information came only 2 weeks ago or 2 days ago. We ask ourselves the question that from the date of first application, if there is a certain amount of time that is being taken, what is the reason for that? What can we do to automate? What can we do to streamline our processes? What can we do to allocate more resources so that the pendency and the aging of these requests for approval are brought down to the minimum? So the data that you are seeing is a no excuse data. This is not buffered by saying, oh, it's from the last date that we received all documents. This is from the first date of application. So I would like to share some of this data in a little more detail. So you've seen the data before you. Broadly speaking, we've broken it up into the key areas of capital formation and fundraising. So if you see the equity side, and this includes all forms of equity raising, whether it is IPO, rights issues, etc., etc. And you'll see there that the pendency, which used to hover around the 50 mark at any point in time, is now down to under 30. So first, the way in which that graph has moved is important. But I think what is even more important is the aging analysis. Because we, in fact, are happy if more applications come, right? It's a sign that the economy is vibrant, the markets are vibrant, more fundraising is happening, so the more the merrier. We are very happy if more applications come. So in itself, if pendency goes up, it's not a problem. The question is of aging. And therefore, what we as SEBI are particularly proud of is if you see the aging analysis, which means more than 3 months, So 5 quarters ago, this was 11 plus 8, 19 cases were pending more than 3 months. Today, this number is down to 7. I suspect that, we unfortunately don't have June data here, but I suspect that it would have improved even further. So, therefore, the question is that people who want to raise equity from the markets should not have to experience long queues in SEBI. The pendency should not be there, and there should be a quick turnaround in terms of approvals. That's the objective, and this is what we are focused on. And as I said, we've deployed both technology, standard operating processes, as well as focused teams in order to make sure that these numbers come down. Going forward, I think there is still room for improvement. However, our sense is that this will require a much deeper partnership between the merchant banking community, the investment banking community, and SEBI in order to streamline the processes even further, in order to bring these numbers down even more. In terms of mutual fund schemes, you would have seen that the improvement is even more dramatic. So you used to have schemes pendency which was in the 175 number mark, and today it is down to 6. And that too, as you can see, 4 out of those are less than 1 month old. So a lot of processing streamlining has happened to bring this about, so that again, when there is a timeliness of certain new products in the market, certain opportunities, SEBI should not be wanting in terms of giving speedy approvals. So now, as you can see, there's practically no wait time there at all. In terms of AIF schemes, again, the numbers are very similar. Roughly about 145 odd is down to about 56, 58. And more importantly, more than 3 months, which earlier was a very significant part, 58 plus 13, that was a very large number, which was more than 3 months old, is now down to just 1. REITs and InvITs, the numbers themselves are small, again, so it's not so representative as a large sample base. But again, now you're seeing that, the aging, etc., and I think my team has made a note to say that that one item which was pending is now cleared. Similarly, in terms of, the next slide is on the pendency of registration of applicants. So meaning not, so in this case, for instance, mutual funds, this means new mutual funds. This does not mean new schemes of old mutual funds, but new mutual funds. Here you would see that again, while pendency is down, the aging is not. The underlying reason is usually in the area of 2 categories. One is that the net worth requirement of the applicant is not being met, or that it is awaiting approvals from some other regulator. These are typically the reasons which keep these items pending for a bit longer than any of us would like. We are hoping to work with the industry to try and find a solution to these issues as well, and perhaps some kind of in-principle versus final approval may solve for that problem, so that they are clear that there is no uncertainty from our side, subject to their net worth compliance and approvals from other regulators. On the AIF side, again, you'll see similar pattern, close to about 70 pending items 5 quarters ago, down to just over 40, and the aging dramatic improvement. Earlier, there were as many as 40 items more than 3 months. There are now 0. REITs and WITs, again, the numbers are small, but hopefully, as I said, some improvement in the aging. So to us, I think what all of this is really a manifestation of our desire and focus to make sure that capital formation happens at the speed that the market needs, and that we do not come in the way of that capital formation happening. In fact, we are facilitating this, and with this reduction in timelines and aging, we should be in a position to facilitate even faster growth of the markets. In continuation of the theme of time is money, we wanted to share some of these numbers with you because, while each of these items in themselves has a very significant impact to the players, but when you aggregate it, it's even more interesting. So, and a lot of this is really driven by the technology. So, as we think about the market stack that we have in India and what it has facilitated, and just a handful of items that we put together for today shows us that as much as 3,500 crores of actual interest value, this is not the gross amount, this is the time value of money on a per annum basis. So 3,500 crores of the interest value of funds which have been released into the system on account of the improvements that we have brought into the ecosystem through the use of technology. This is on an annual basis. So just talking through some of it, and I started specifically with ASBA in primary markets, even though this is an old item, but continues to be a very, very strong basis of everything we do in the IPO market. So, as you can see here, essentially during the period that the investor's money continues to reside in his savings account, even assuming that he invests it on the last day of the IPO, the total volume here is really close to 6 lakh crores over a year, okay? And this excludes anchor investors because their money doesn't get locked up through ASBA, it doesn't get done through ASBA. So just for this 4 days, the annual benefit that goes out to investors is 260 crores. Now when you take that and move it to ASBA-like systems for trading, right? See the difference it makes, almost 10 times. So 2,300 crores of interest value will go back to the investors on the basis of close to 60,000 crores of margin that is posted by them. And this is just for what we call the qualified stockbrokers, the large stockbrokers, because this has been right now envisioned for only them. As the ecosystem develops further capability and the other brokers also adopt it, this number would actually go up. And in theory, I'm told it could even go up double. But for the moment, we are assuming conservatively that the qualified brokers will make this facility available, and if all the investors choose to use ASBA-like facility for trading in the secondary market, a total of 58,000 crores will continue to sit in their savings account, and on an annual basis, investors will earn 2,300 crores extra. T+1 settlement. As you know, this is a global first. India is the first major economy that has moved into T+1 settlement for all its scrips. And this is something that, I'd mentioned earlier that in IOSCO, where all of us fellow regulators meet, this was something that was considered really quite path-breaking. And many of the jurisdictions conveyed that they were facing significant challenges, both in terms of technology, processes, and a buy-in from the system to actually move into T+1 settlement. But the immediate impact, again on a conservative basis, is almost 10,000 crores of margin has been released back into the system. Because earlier, the margin, if you trade on day T, you keep the margin for 2 days. You trade on T+1, you again keep it for 2 days. So on a rolling basis, you're keeping 2 days margin. Now you're keeping only 1 day's margin. So almost 10,000 crores is the average reduction of the market level margin. And again, this is only for equity cash, because as you know, T+1 settlement, the impact is immediately on equity cash. And the time value of money for this is 700 crores. On the back of T+1 settlement in the equities market, we have moved mutual fund redemption, also the timelines. And what we understand is that while our regulation, the impact is 4 days, but In actuality, the benefit is about, on an average, half a day. So we, again, on a conservative basis, assuming that this 24 lakh crores, and this is only equity and hybrid. Naturally, overnight schemes and liquid schemes, it would not be appropriate to include that here. So just for equity and hybrid, the number is 24 lakh crores. So just half a day average benefit of earlier redemption means a benefit of 230 crores. So again, as you can see, very conservatively calculated and totaling up to 3,500 crores per annum is the benefit to the investors. So what this really does for us is to constantly motivate us to move into more and more structural encouragement to the ecosystem to deploy technology and therefore to be able to crunch timelines. And certainly one of the things that we think is not very far off is even instantaneous settlement on the stock exchange. We are currently working on that. We are engaged with the ecosystem and we believe that in the not very far future, we will have a mechanism which will facilitate instantaneous settlement of transactions on the stock exchanges. So that's where we are headed on that. I would then like to move on to these slides. Again, they are before you. These are not new. We'll come to the new discussion items a little bit later. But we thought it would be relevant to bring together some of the more relevant items to capital formation and ease of doing business together in one place. This is what we've done over the last roughly 1 year in terms, 1 year, right? Over the last 1 year, a lot of stuff even before that, but just to take stock of the last 1 year, what are all the initiatives that SEBI has implemented just in this narrow space of capital formation and ease of doing business? This is not comprehensive because it doesn't cover a lot of other spaces on which we have equally done a lot of work, but just to focus on capital formation, which is one of our key objectives. So if you see here, starting from flexibility for confidential filing of the draft of a document, this was a request that many, I won't call them startups because they're really quite big by the time they come to the market, but the new tech companies, many of them had expressed this requirement, which we facilitated. So they can do confidential filing, they can start testing the market, and only when they are confident that they want to actually go with the IPO, then the prospectus is made public. The second was permission to pension funds as anchor investors. There was a set of pension funds that were not permitted. This was relaxed in order to just facilitate, again, greater number of participants who could come in, particularly when the lead managers, since particularly for large issues who have a large number of lead managers, then their pension funds were being precluded from participating in the process, and that became a needless requirement, which we have now relaxed. Faster access to funds. You're all aware of the T+6 to T+3, and this was a perfect case. I think a perfect case where it was win, win, win. The issuers delighted that they would get the money 3 days earlier. Those who got allotment delighted that they get their shares earlier. And those who didn't get allotment delighted that their ASBA block was released earlier. So everybody was happy, and this was really facilitated by technology again. So, you know, as I call it now, our India market stack again has facilitated this, and we were very pleased that this could be done and literally give winners all round. The next one is in terms of the procedures for buyback. We simplified this. SEBI's comments on the draft letter of offer was just dispensed with. We did an analysis and found that there was really very little value add that we were doing in terms of a buyback proposal. It was already a listed company, disclosures were already being made, the scheme was transparent, and we felt that there was absolutely no requirement for us to intervene and the data supported this view, and therefore we went ahead and simply dispensed with it. Along with it, we also dispensed the requirement for physical documents to go to shareholders, and the buyback timeline was also reduced and optimized so that the entire process is concluded speedily. In respect of open offers, again we made relaxations. One was specifically for the PSUs. Some of you may recollect that we had taken a view that some of the regulations that were there were really not applicable to public sector units at all, in the sense that the risks that were envisaged simply did not exist in a PSU environment, and at the same time the kind of processes that a PSU needs to go through in order to find a suitor for an acquisition is completely different from what it is from the private sector. And therefore, again, we changed the determination of the open offer price to make it much more realistic for the divestment or disinvestment of PSU companies. And some small matters, but again, time is money, money is time. Instead of 100% cash deposit, bank guarantee was permitted as an alternative. For us, the approach was, what is the risk we see, and is there a better way to cover that risk, and which can be beneficial to the participants? And therefore, we found that this was a very easy way to again give the benefit to the participating entities. The third was flexibility in terms of methods for complying with minimum public shareholding norms. Again, the approach very much is that what is our regulatory intent, what is it we are trying to achieve, and if there is no significant risk perceived in certain ways of doing things, why not give that flexibility and freedom to the market, so long as there is alignment with the end objective, and if everyone is agreeing that they want to go north, whether they want to take one road or another road, they should be given that freedom to do so. So that also was implemented in the same spirit. In terms of debt issuances, there was a whole raft of reforms, most of them developmental in nature. The first was a huge move in terms of simplifying processes. So people who are frequent issuers in the debt market, every time when they wanted to come to the market and make 6, 7, 8 issuances, every time the same procedure, the same documents, it was just so onerous. And we again thought about it and said, what is the incremental value add of doing this? And we came to the conclusion it was nil. And therefore, moving into a mode where you file the general information document once for the year, and then for each issuance, it's a very, very slim and simplified document of the key information document, and then you can do away with all of these multiple filings and costs related to that. The next one is the online bond platform. As you know, there has been a lot of attempt from many people in the ecosystem that how do we bring in more liquidity into the markets, into the bond markets. Retail participation was practically nil. So we found that organically there were springing up online bond platforms, but they came with certain contingent risks. Now, our objective was really to be able to facilitate what organically was evolving in the market, but with suitable risk mitigation measures so that the foundation is strong, and then we can encourage the whole superstructure to be much, much bigger. So this online bond platform, therefore, really was a step in this direction. Flexibility in the private placement piece in the electronic book building platform. We had got a lot of feedback as to what was working there, what was not working so well, and we brought in various things in order to be able to make that process more efficient. Framework for green bonds so that different types of fundraising could be facilitated. Framework for voluntary delisting. You've heard me often say that, in SEBI we don't like abhimanyus. So nobody should feel that once you get in, you cannot get out. And therefore, there was no framework for this, which we introduced to enable people to be able to voluntarily delist. Various additional measures to ease the modalities were also introduced, including reduction in face value of debt securities. We hope that this, in conjunction with the online bond platform, will facilitate a lot more retail participation. REITs and InvITs also, we think this is a very, very important mode for capital formation in our market going forward. We see a lot of overseas interest in this domain, and therefore flexibilities that were required over there, first of all, for their leverage, because they are permitted leverage, as you know, REITs and InvITs are permitted leverage. So to facilitate it through issuance of commercial paper was facilitated. In order to give the sponsors the ability to exit and to facilitate professional investment managers to emerge, we created the concept of a self-sponsored investment manager. This has been received exceedingly well by the industry. And lastly, because this is very large, bulky assets, relatively concentrated, the unit holders felt the need to be able to have a say in the way in which the fund is managed, and therefore the flexibility to nominate a director was given not only to those who independently held 10% of the units, but also permitted that on an aggregate, if multiple unit holders were able to put together 10%, they would have the flexibility to nominate a director. So these were some of the key things that we thought we'd put together to show the progress that we have made over the last year or so in terms of assisting capital formation. This is really, that's a needle in a haystack. I think this one piece that we have done, SEBI has done over the last 1 year, is perhaps as important as everything that I've said over the last 4 or 5 slides. And that is now the publishing of master circulars in every single space in one consolidated piece overriding everything else. To me, the ease of compliance started from a point of saying that tomorrow if I set up shop, do I have one place where I know this is what I have to comply with, nothing more, nothing less? That one document we felt was really, really important for us to do. We had had master circulars in the past, but not as a consistent practice across the board. We have now done that, and I think today there is practically across every single department. I think one exception is there, which they're still working on getting clearances from legal. We now have this master circular completely updated, which overrides everything else, and so there will be no more need for any market participant to hunt for the needle in the haystack as to what exactly do I need to comply with. So to me, ease of compliance, this was a very important step which SEBI has taken. Now the question of going forward, and in this process of going forward, there are some specific areas which I will talk about, again in the context of capital formation. But equally importantly, today I would like to talk about something which is what I would call a new regulatory design. Now this is really important. I don't know if some of you may already have heard some murmurs about it, because we sent out some letters yesterday and today on this issue, so maybe some things have already reached you. But essentially what this new element in the regulatory design that I would like to talk about is as follows. We have seen over the last many months that as we bring out various regulations or we modify various regulations, we find that at a policy level, we have a lot of valuable input that comes to us from our advisory committees, from public consultation, in terms of how should SEBI try and balance the need for ease of doing business with the need for building trust in the system and regulating the market well. So we get a lot of input. We take that input and create our regulations, and then of course we have public consultation, and then we finally approve it. However, when those policies, regulations are translated into implementation, so we're now thinking of the implementation phase of SEBI regulations, we find that two things happen. One is that a lot of queries come to us about saying, how are we exactly supposed to implement this? Will this be an adequate implementation? Will that be construed as a violation, or will it be construed as adequate compliance? Now, we came to the conclusion, our first reaction was to try and explain this either through FAQs or through more detailed circulars. That was our first response, to say, well, we know our regulatory intent, and if we get a lot of questions, we will try and explain it through FAQs and more detailed circulars. But on deeper reflection, we've come to the conclusion that what we are really conceptually dealing with here is standard setting for implementation. This is not the regulation. This is how to execute and how to implement. This task is best done by industry bodies themselves. So, therefore, the question is that, and we have had some experience in this, I would say, let us say in the mutual fund space, where very often you would notice that our circular says, let's say for instance, valuation. It will say that AMFI is to stipulate the standards for valuation, and then everybody follows that. Similarly, let us say for benchmarking of performance, we say that the industry body will select the entity which will do benchmarking. So we have some experience of it, but I think that now the conceptual construct of saying that our regulations will take us to a certain stage of expressing the regulatory intent and expressing as to what is to be done, but a lot of the ease of doing business or otherwise lies in the details of how to implement. Now let me give you an example, and that will illustrate where we are headed and how we intend to go in that direction. So let's take, for instance, one of our recent circulars on rumor verification, right, for listed entities. Now, the regulation in the circular conveys the intent of saying that if there is a rumor in the market about this listed entity, and it's already there, it's already making the price move, then the company needs to come in and verify or otherwise about that rumor. Now that's a regulation which nobody has any dispute over. What the challenges that industry faces is, now how are we supposed to implement this, right? So for instance, in our discussions, what we understood was that most of the large corporates already have a media tracking service, right? They're already tracking it. The CEO gets on his table every morning a media tracking service report which says who said what about you, right? It's already there. Is it our desire as the regulator that they should now invest hundreds of crores in building a parallel system? Of course not, right? So what is the solution to this? So to say that if the industry sets a standard to say, if the media tracking agency has the following coverage, this will be considered adequate for the purpose of tracking whether there is a rumor in the market or not. Now, if in some corner of the world some blogger has said something and that does not show up on this, the corporate SEBI will never take a view that, oh, you know, in that far corner of some part of the globe, there was this one blogger, and that's not our regulatory intent. So if there is a standard saying, here is the coverage, this is an acceptable standard of coverage. By the way, the industry may also choose to say, here are the 5 media tracking services that we think already have this coverage. Now, as far as the company is concerned, its board is concerned, its audit committee members are concerned, they can all rest comforted that, okay, once we've subscribed to this, have we covered whatever the regulation requires us to tick? All right. Now the next question is, we've been asked by a lot of people, including independent directors on boards, etc., that, you know, your regulation says, you know, it's a specific rumor. Now, what is meant by specific? Okay. Now, the best way to do this is for the industry again to set a standard and says, what does specificity mean? If somebody generally says Hariharan is looking to acquire a company, it's an IT company, he's looking every day, 365 days of the year he's looking. This is not a specific rumor. However, if there is a specific name, entity, you're looking to acquire X, or there is a specific value, you're looking to acquire X at a price of so many $1 billion, $1 million, $100 million. There is some date saying in the next 2 weeks this is going to happen. There is some specificity to what the rumor is, and this is a standard that industry can set and say this is what is meant by specificity. Then that's another tick. Everybody knows these are the rules. Then to say, okay, now the regulations require that the company must respond. Now, what is an adequate response? Now, clearly a response that says we don't comment on rumors is not an adequate response. There is a rumor, you have to say something. Now, again, based on our discussions with industry, we learn and we understand that at the end of the day, this is not an infinite universe of things. In a corporate's life, some 10, 20 things happen, right? For each of those 10, 20 things, whether it is the results, whether it is a large deal, whether it is a regulatory action, whether it is an M&A, whatever it is, it's a very finite list of a few items. And it is not hard to put down a standard to say that if the discussion is at, let's say, again, take the most sensitive issue of M&As, if it is at a very early stage, what exactly would be an adequate response for the company to make? Or if it's at a very advanced stage and you're going to take it to your board tomorrow, what is an adequate response to make? Now, these are standards which the industry can craft. Of course, it's best that they bring it to us and they consult us. Why? Because of 2 reasons. We have in the past found that certain things that we say, some people go to the extreme of over-engineering the compliance. That is never our intent. So if someone says, no, you must do this, that, and the other, and you come to us and we say, boss, that's not our intent. Even if you do this, we are quite happy, right? The other is, of course, for us to check that, yes, broadly speaking, the standards that are evolving are aligned with the regulation. It's not regulation is saying you go north and actually this standards are going south. That cannot be alignment. So with this process of consultation, then the industry body finalizes these standards and everybody now is comfortable that I'm following the standard and I'm compliant and nobody needs to worry about it. So we are hoping that this kind of an approach, if we take across the board, and perhaps the largest set is really of the listed entities, right? For mutual funds, there are 40 of them. It's much easier for them to coordinate under the aegis of one association. But for the listed entities, maybe it's a little bit more, will take more effort to arrive at these standards. But this is I would say, architectural shift that we wish to experiment with in SEBI. So we have sent out letters, I think yesterday, to the industry associations like CII, FICCI, ASSOCHAM, etc. Also to the professional bodies like Chartered Accountant Institute, Company Secretary Institute, and to the exchanges, because the exchanges are the ones where all disclosure and reporting happens, and therefore if under the aegis of the exchanges a forum is created with all of this representation and the industry itself puts in place these standards in a way that is easy to implement. Okay. So, as I said, our objective is that the regulatory intent of disclosure, transparency, investor protection must be met. The easiest possible path to that objective is what we ourselves are desirous of following. So it's best that industry determines what is that easiest path for them to follow to get to that objective, and we would be very happy to endorse that and to facilitate it. So, as I said, we've written to these entities, also to a few industry leaders, I think our Nifty 50 CEOs and so on. We are in the process of reaching out to them to say, please tell us whether you think, first of all, this architectural shift will help, and if it will help, then for the first pilot program, let's, we start everything, this is our version of the sandbox. So let's try it, let's do one. So any nominations that are there as to which of our regulations in terms of setting the industry standards, we're very happy to support. And we do this in a time-bound manner and see whether this is a good way of doing things, and will it help the industry in terms of ease of implementation, ease of execution, ease of compliance. Okay? So that's, I would say, a architectural element in our regulatory framework that we would like to try out on a pilot basis, and if it works, we would like to actually extend it and scale it up then across the board, not just for listed entities, but all kinds of regulated intermediaries as well. Moving on to some of the specifics of what is currently in the pipeline within SEBI, just to give a flavor of this, this part of our whole mandate that we seek to serve. And actually, it's interesting. Last time I had made a statement some time ago, maybe 2 quarters ago, that so far, at that time, we had about 44% of all our circulars were in the realm of development and ease of doing business. And I'd said that that's because we've done a lot of harvesting of low-hanging fruit. So going forward, it would be more in the range of 25 to 30%. So indeed, we ended the year with 37%. So we've taken stock. It's important for us because we want to measure it to make sure that this three-pronged approach and three-layered objective that we have is all balanced, right? So all of these, investor protection, development, and regulation, all should be balanced out. And so that's what our number was at the close of last year. Close of last year or close of June? Close of June. Okay. Now coming back to some specifics of what more we are thinking of doing, and I will hand over to my colleagues to talk through it. But again, the philosophy, this is meant to depict what I was referring to earlier. We don't want Abhimanyus in the market in any form or manner. So 2 of our regulations which we are reviewing, one is delisting regulation, and I will request Mr. Bhatia to talk about it a little bit.
Second one?
And the second one is trading plan for perpetual insiders.
So delisting is something that we have been thinking for some time. We've already had an advisory committee give its recommendations to us. It is still very early. Mr. K.K. Mistry was heading the committee, and we proposed to take it first to the advisory committees, and later on it will be open for public discussion. So currently the arrangement that we have is that we have a reverse book building. And then the moment you touch 90%, you arrive at a price. Industry has been coming back to us and telling us that they have found certain problems there. So very early again, as I said, we will be taking it forward to the advisory committees. We will say that if you have a requirement for delisting, you can also have a fixed price. You come with a fixed price, you can try that. If that doesn't work, then maybe try the reverse book building. And if that fails, we'll give you time again, maybe 3 years, maybe 2 years, maybe 1 year, depending on the discussions that we do with the markets and what the advisory committees tell us. So that will go a long way in helping companies who don't want to be listed anymore.
That already exists.
No,
The delisting, of course, there is a price you can offer.
no.
There is a price you can arrive at through reverse book building.
No. But, okay. So let me articulate what is the problem experienced by people
Reverse book building.
in reverse book building is that their concern is that certain constituents in the market,
Tend to jack up the price.
first, in anticipation of the delisting, acquire those shares in a concerted bid and which crosses the 10%, so that they are not able to cross the 90%. And then in order to cross that 90%, the price is jacked up to a very, very high level, which is unsustainable for the entity. That's the problem statement that the industry has articulated. So the committee has now deliberated on how to solve for this problem.
But sir, ma'am, is there data to support that from the industry?
Yes, you know we never do anything without data. We never do anything without
They
data.
actually have proof of people cornering their shares.
No, it's not a question of people. It's
Acquiring more than
no, it's not a question of people. It's a question of looking at the bids and seeing that what happens to the bids as you approach the 90% number, what happens. So there is enough data. As I told you, we never do anything without data. And when the consultation paper comes, that will also be part of the
Reverse book building has been under attack for 2 decades now.
So isn't it about time we did something about it?
But
No, it's been under attack by corporates for 2 decades. Shareholders have always appreciated the fact that it maybe gives them an opportunity to use their shareholding to extract the maximum value possible.
Yeah, so there's sometimes a difference between getting your fair value and extracting more value. So I think we need to balance out the requirements of both
So
the...
you're reviewing full reverse book building.
Yes.
And what's the timeline?
can't see.
I would imagine before December you'll see a consultation paper out.
But there have been instances where the reverse book building has also happened at below the market price. There have also been some cases there.
Can you look at...
Sorry, time out, Mr. Haryana is reminding me, should we finish the presentation? Only 2 more slides and then we'll come back to Q&A.
Sorry.
Okay, no worries. So the next set of Abhimanyus in the market are perpetual insiders, and this has been an area of concern for them for the longest time. We have a mechanism called the trading plan. Again, the data shows that this has not worked well. It clearly doesn't work for people, and therefore the need was felt to review it. Over to Mr. Anand.
Yeah, as the chairperson mentioned, under the prevention of insider trading policy regulation, we have the concept of a trading plan where an insider can adopt a trading plan and therefore not be subject to the requirements of insider trading, etc. Now, the feedback that we've been receiving is that this trading plan is fairly onerous. The way it works is that if you get into a trading plan, you have to declare that from 6 months in advance. Thereafter, you're locked in for about 12 months, where you necessarily have to act on that particular trading plan, even if the share price was to move very dramatically during that particular piece of time. So, if theoretically the share price was to fall dramatically for reasons outside of your control, because you've declared it as part of your trading plan, you would still be forced to sell the stock because you committed this several months ago. Now, even as we changed the LODR regulations on what constitutes a material, piece of news, and we had a consultation paper out on saying that, we don't have enough items being tracked as UPSI or unpublished price-sensitive information. We realized that as we go down that path, we will only be requiring more UPSIs to be declared, which means the need for firming up a good trading plan process it becomes all the more important. So which is why we've set up a committee of market experts, of companies, of legal experts, etc., which will look into making the implementation of this trading plan a lot more user-friendly. We are hoping that this committee will come out with recommendations pretty soon, and by end of August we should have a consultation paper out, which will hopefully go a long way in easing the implementation of this trading plan. Thereafter, the other regulatory changes, if necessary, can take place.
One more one which we've seen, and this is where I say that we've started looking at things from a first principles point of view. So there is a requirement of board evaluation, as you know, by listed entities. This is done, and then there's actually no filing of that data, and there is no disclosure of that data. And therefore, what we felt was that given this situation, what this really is in the nature of a best practice for boards to follow. In any case, it is not being disclosed. In any case, it is not being submitted. And therefore, something of this nature then rightfully belongs in the voluntary space and not in the mandatory space. So we are again reviewing. So just to, as I said, these three examples have been picked up just to give a flavor of the way that we are thinking about things in SEBI, that if something is not required, why is it there in the law itself? And if something can be made voluntary, why not make it voluntary? If standards can be set by the industry, why does SEBI need to stipulate? And so on. So that is our underlying thinking and underpinning. So again, this is something that of course will go through the normal process, but again, board evaluation, is it really required to be mandated or can it be voluntary, is another example. So I will stop here with just saying that, as I started out by saying, that India is in this wonderful place and we're all so fortunate to be here at this point in time. And we certainly consider ourselves extremely fortunate to be able to play a role in this whole India growth story, the economy and the capital formation. And so we intend to go down that path hand in hand with industry. That's it.
Thank you, ma'am. We will open for questions. Request that all of you will take opportunity to ask questions. So you can do that now. Yes, go to that office.
I hope we'll be allowed not to stick to the syllabus. We were expecting the circular on the announcements made in the previous board meeting about FPIs will be more than 50% in one share. The rules have not come out. When are we expecting it? Why the delay? Is there any opposition to it?
No, there is no opposition. I think, I don't know whether we are raising the bar constantly on ourselves. Lata, the board meeting was held in end of June.
28th.
We are now sort of 3/4 of the way through July, and normally it's a 3-month cycle for all notifications and everything. So, so no, there is no opposition. It has been approved. It will be notified. It takes a certain process for it to be notified. Language translation, notification through the Gazette, etc., etc. It's a normal process.
Okay, yes.
Ma'am, I have one question on a few things that you spoke about. You spoke about IPO also in terms of the time period and the value of money. The abeyance period is something which a lot of entities have pointed out.
Sorry, what
The
period?
abeyance period. If SEBI puts the IPO in abeyance period.
Yes, sir.
Yeah. So the abeyance period is something which they pointed out that no matter what's the degree of problem with the promoter entity, the IPO is put into abeyance for an entity which needs capital. Are you looking at segregating the abeyance period depending on the nature of the problem with the parent entity?
I think you're right, and they are right. And therefore, now what has happened is that we have started, so we've created sort of an internal SOP, which we will crystallize more clearly on the return of applications. So where there is, and that's why I said that, any further improvement or reduction in timelines will depend on a collaborative work with the issuers and their merchant bankers. So things which typically, were reasons for abeyance, as I said, is another regulator has not given approvals. So we will now have a simple policy where we will make sure that in terms of filing fees and all of that, there is no impact on the person. Right? So it's not as though when we return an application now, when you come back, once you get the other regulator's approval, you will come back and then, again there will be filing fees and all. We will not have any of that. We are crystallizing the policy to say that when there are certain matters where it's dependent on you, okay, and you need to get something from somebody, clearance from somebody or whatever, then we will return the application. It's not a question of abeyance. And whenever you come back and we will not charge you any additional fees.
Two very short questions, and I apologize for bringing this to your door. But as you spoke about, clarification on rumor, just wanted to ask, would this apply on the regulator as well, in the sense that if there is something expected from the regulator, which is moving the price, if something is written to you for a response, would the regulator also respond on that? And the second one is out of what we've discussed, the TER regulations. They were expected, by when do you see the revised consultation paper coming? And if you could give us some clarity in terms of, as you said, significant relief, some definition, some color of that significant relief.
Okay, so the second one is really easy. We've had one round of discussion with the advisory committee, the Mutual Fund Advisory Committee. The team is now again processing the inputs that we have got. Some more recomputation, calculation, etc. is being done basis the requests and the submissions in the advisory committee. So it won't be long, but I think we'll need to wait to see. As I said last time, that we are now in that co-creation stage. It would be too premature for me to say anything more detailed than that. In terms of rumor verification, in terms of SEBI, I think it's a very important point that you've raised, and in fact you might recollect in the context of the mutual fund TERs itself, quite as a departure from our normal practice, we actually issued a press release when we started deliberating the matter, because we knew that it can move the price of various listed AMCs. And similarly, you know that the process we followed was a much more closed process compared to our normal, very open and consultative process when we designed the first thing, because again, it could have moved the market. So I think that it is very important that, if there is something that is in the policy realm, okay, so let me break it up. Policy realm and enforcement. Enforcement is enforcement. It is, all investigations are strictly confidential, whether you have a rumor or don't have a rumor. It is impossible and inappropriate, completely inappropriate for a regulator to comment on it, because you are then essentially allowing a trial by media instead of a trial in the quasi-judicial process. So that would be completely irresponsible for the regulator to comment upon. However, when it comes to policy matters and the impact that it could have on people, I think it's important for SEBI going forward, we've already done it the first time, that we should be more conscious that if this is going to impact somebody, let's say it up front. And then indeed, as you said, if we fail to do that and if it results in a rumor, I think indeed we would be duty bound to respond to it in a responsible way.
Thank you.
Actually, I have some slightly more informal questions to ask about this architectural shift as you described it. Is this prospective? Does it already apply to any of the regulations that you already put out? Because
any of them, we are happy. We are saying that it could be, if we set it up as a mechanism, we would be happy to take that forward, not only for prospective, but if people are facing challenges in implementation of existing regulation, happy to do that as
So
well.
the existing regulation that you use is an illustration, and if I may use the same,
Yeah.
which is the market rumor one.
Mhm.
I'm a little confused about this new approach because typically SEBI has always run a consultative approach, and where they felt
Yes.
that those that are the subject of their regulation will face difficulty in being implemented.
Mhm.
That has been dealt with in the consultation period.
Mhm.
So this shift that you're describing in approach seems to suggest that you want to put an existing regulation under review. Is that the
No.
correct way to understand?
No.
Because this whole market thing has come up multiple times.
No,
Marketing,
I'll tell you.
right? Like-
No. So, no. So the answer is, the short answer is no. The long answer is, we expect to see, as I said, the advisory committees and the public consultation is not going away. The issue that industry gives us is the devil is in the detail. So while all of them come and say, we have no problem with the principle of what you're saying, it's just that in execution you have not appreciated X, Y, Z, which is a devil in the detail issue. So as I said, that's why I gave a specific example, that which all, media should I cover? Now, it's just impossible. How do I get my arms around it? So we're saying, okay, make a standard. It's done. So it's not a question of saying, so what I'm saying is, if people are facing challenges in implementing even existing regulations, let the standards be set for that by industry, and whatever that feedback loop to us, we're very happy to consider, and we will accordingly then take care of it. So that's why I said it's an additional element in the regulatory architecture, which is to facilitate greater standardization in execution, not in policy formulation, in execution, so that the people who are today worrying about it a lot and over-engineering the compliance need not do so. And as they say, that there are some people who are under-engineering, so they also know what is the standard. So people don't need to worry once a standard is established. That's the purpose.
May I just ask one follow-up clarification? You cannot divorce enforcement from the wording of the regulation when you put mainstream media in a regulation, or you put media registered with the Indian Publishers Association, or media registered with the Broadcasting Ministry. The regulator knows at that point in time itself that it's opening up companies to respond to rumors on a very large number of newspapers, TV channels, etc. This was known when the regulation was crafted. So to now suggest that this becomes an enforcement challenge or an implementation challenge, and therefore now industry can come back with a new...
No. So
media
Menika,
tracking agency.
that's what I'm
There
saying.
could be multiple.
So Menika, I think many of you, I'm sure you all read each other's articles as well. It's not us that only read your articles. So it has been suggested that people will need to invest hundreds of crores in actually being able to track, to identify whether some rumor has come out somewhere. This is what has been suggested. Okay. Now I'm saying that's neither our intent nor our desire nor required. And that was what we always knew to begin with, because industry had told us that. Now I'm saying, if there is an anxiety that, each company will spend 100 crores to do this, I'm saying let the industry make the standard that if I subscribe to service number A, B, C or D with this thing, with this mandate, with this coverage mandate, I'm good, I'm in compliance. So it takes away the need for anybody to over-engineer their compliance requirements, and certainly removes the need for anybody to spend hundreds of crores, as has been suggested in some quarters, for simply being able to track what media tracking services do in a few thousands of rupees.
So I thought this was a push, this was the success of a pushback from industry, but this seems to be the success of SEBI's pushback, saying you formulate the standard and we're willing to agree with it.
We're willing to, of course, because I'm saying at the end of the day, I am in full agreement that the devil is in the detail.
And it's not yet applicable to any regulation. So you're asking for industry to come back to you with the framework, and then you will decide which regulation
No. We have asked, no, let me put it this way. We have suggested let's do a pilot. And for that pilot, we have said that we've asked industry for suggesting 3 or 4 regulations that they feel might be suitable where they are currently facing challenges, so they can come
The
back.
disclosure regulations are the ones where they're all most.
Possible.
Most,
So just an example.
Possible.
Yeah.
But it's possible, and then we are happy to have it. We don't have a problem at all.
Sally, what
Yeah,
is your
some clarity on this.
Hi.
So one clarity on this. So this amendments have already taken place. So these rules will now be on hold till the time this industry decides the standard. Or
No. The rules are notified. There is a certain, and that implementation plan is on. That's why I said we are happy to review future regulations. We're happy to review past. If the industry comes back within 20 days and says, here we have our standards, we're happy to look at it. So nothing is on hold. We are saying that right now people are following it basis what their understanding of the right way of implementing is. If they come back within 3 weeks and say here is our 2 weeks or 1 week to say here are the standards we would like to recommend, we will take a look at those standards and say yes, we are comfortable, not comfortable, and then they can proceed on that basis.
So just to confirm that, no regulation right now is being put in abeyance or is
No.
being rolled back or diluted as a result of this. This is all prospective. This is all prospective.
Yes.
Okay.
also this there has been a considerable
No,
improvement.
let me revert that. We are open for people to come back for any regulation, prospective or past.
Correct, but it will get amended. You're not.
No
freezing any
regulations are on hold. No.
Nothing.
No.
And you're not committed to amending a specific regulation or group of regulations.
No.
This is the implementation of those
This is
regulations.
implementation. I think
This is not about the regulation
this
itself.
is not about the policy. It
Regulation
is.
and the implementation go hand in hand. You cannot make a regulation effective without implementation
Sure.
kicking in, right?
So just to clarify, the regulations stand as they are. The principles behind the regulations stand as they are. The implementation, as chairperson mentioned, the standards, what you need to do on the ground, where does the rubber hit the road, that standards can be defined by the industry is what we're suggesting.
I think the underlying question we all, at least I definitely want to ask is this some degree of lobbying by industry on genuine, non-genuine difficulties faced by some of the disclosure regulations you've introduced? Is this the result of that?
Always,
That's the question.
always, because this is what I find sometimes very strange. Somebody, I think I mentioned this to some of you who I met informally somewhere. Somebody said to us in a very accusing tone that you do consultation and then the regulation that comes is often quite different from the consultation. And I'm thinking, you're accusing us of something? I thought the whole purpose of consultation was to take on board the feedback that the market gives you and to respond to it and to accommodate that feedback in your policy. That was the whole purpose. So it was not clear to me why that was a bad thing. So I'm saying again over here, we are always open. Always our doors are open for market feedback. And if we get feedback that there is alignment on the objective but difficulty in implementation, we are completely, and I repeat, completely open to saying that we have no problem. As I said, if there is alignment on the objective, we are all going north. Which road you take to that north, we want you to have the easiest road to go north. We have no desire for you to take the toughest road to the north.
Sally, can you please share this?
On one hand, there have been significant tightening in regulations, and now SEBI wants to ease the exit or the delisting process. So won't there be a fear of a lot of companies choosing to go private? Because of the kind of regulatory owners that is being taken.
So I'm not sure I understand exactly the link between the statement and the question, but let me put it this way. The philosophy, as I articulated, was it isn't right for anybody, that once you're in the market, you can't get out. We said this when COVID was happening and many markets across the world were shutting down, and there was tremendous pressure on us to say that, shut the market, limit the trading hours, etc. And we took a view that that is not the right thing to do. A person who enters the market should have the right to exit the market. And therefore, the parallel with Abhimanyu, we don't want once in, never out, cannot be. Okay, Hotel California, you can check in, you can never check out. So that's not what we like. So to us, it's a philosophical issue. It is a principle that people who come in should be allowed to go out. And that is why both of these, as you can see, one is the delisting and one is the trading plan. Both are to address this issue.
मैम मेरा एक सवाल जो डिलिस्टिंग नॉर्म्स थे उस पर है. अब अभी बात कर रही हैं कि नॉर्मली कंपनी डिलिस्टिंग अनाउंस करती है, 2-3 सर्किट लग जाते हैं, पूरा कोई मीनिंग नहीं रहता उस प्राइस का. फिक्स प्राइस डिलिस्टिंग आपने एक ऑप्शन बोला. क्या सेबी कंपनीज को ये फ्रीडम दे सकता है कि अगर वो डिलिस्टिंग करना चाहते हैं तो वो सेबी को इन्फॉर्म करके एक ट्रेडिंग सस्पेंड?
Rahul, anything that catches your fancy in the PSU banking space which is not State Bank of India?
So I think Bank of Baroda is one stock which hasn't really taken off. We've seen Canara Bank do well. We've seen SBI do extremely well. Even the likes of PNB has moved. But Bank of Baroda is one stock which is still hovering around its 200 level, and we feel that there is breakout since Bank of Baroda. Now, what has happened in the stock is it's still trading around its 20-day moving average. The multiple stocks for the stock are placed at 195, 190 zone. So we feel that this could be a good area where the stock should see demand emerging.